This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Let's go through now and look at how we calculate the cash flows from your operating activity. So remember, your operating activities is looking at your day-to-day business, isn't it? So how do we go through there and generate cash from the buying and the selling of goods? There are two methods in which we can go through there and work out your cash generated from your operating activities. And the first one that we've got there is referring to, is it the direct method? So the direct method that we have there, it is essentially referring to the information that we take directly from the accounting records. The accounting records being contained within the trial balance and ultimately, if you like, the T accounts. Okay. The direct method, I think personally, if you like, the easier one to go through and understand, particularly if you have no accounting background, is that direct method. Okay. You've then got what's referred to as the indirect method. So even though it's slightly more complex to understand, it is the one that is more commonly used. And the indirect method is whereby we take the figures from the financial statements and use those figures from the financial statements to go through there and prepare the cash flow figures. Okay. This first video here is just going to go through there and look at the direct method. And then what we will go through and do is, once we've looked at the direct method, we can then move on in the next one to go through there and look at the indirect method. Okay. So as we said, the direct method goes through there and uses T accounts. So the direct information from the accounting records, being the T accounts, to go through there and work out your cash from your operating activities. So what you look at there is your cash received from your customers, so your inflows, and from that you then deduct any cash payments that you have for the purchase of goods, so the payments you make to your suppliers, and then any payments that you make to your employees. Okay, so when you're looking at your cash received from the customers, that's going to be there, isn't it, from your cash sales and your credit sales. Cash payments to suppliers are also going to be on your cash purchases and your credit purchases. And then you've got any cash payments that you make to your employees. Okay, because without paying your employees, your business would not be able to operate. Okay, so sometimes you'll have to use T accounts, sometimes you'll have to go through there and just use the information that's given to you within the question, which is maybe a cash figure. Okay, so what you've got here within the example that we have referred to as direct method, it says calculate the cash from your operating activities to appear in the company statement of cash flows. Okay, so you've got some figures at the top straight from, is it, if you like, your statement of profit or loss, isn't it? So you've got there, is it sales for the year, purchases for the year, wages and salaries and other operating expenses. And then beneath that, you then have the figures from your statement of financial position. So you have your opening and is it closing receivables, and you have, is it your opening and closing payables. So what we can go through and do there is, if we have my receivables at the start and at the end of the year, and if you have your payables at the start and at the end of the year, your receivables can be linked into your sales, can't they, to work out the cash you've received from your customers, or your credit customers. And then your payables, you can link that into, is it your purchases? And once you have that, you can then go through there and work out the cash payments that you've made to your credit suppliers, isn't it? Okay. The other figures that you've got, is it your wages and salaries, and is it there your operating expenses? There's no opening and closing figures, so no opening accrual, no closing accrual, no opening prepayment or closing prepayment. The expense that you have is the cash outflow, isn't it? So if we're going through there and looking at things based upon, is it the direct method, then what you've got there first of all is we will need to go through there and look at, is it the cash that we've received from our credit customers. So there is no, if you like, cash just from cash sales, so we'll do that as a working. You've then got there, is it your cash paid? To your credit suppliers. So again, we will put that in there as a working. And then what you've got there, is it your operating expenses? And also, is it your wages and salaries? Get them the right way around. I think operating expenses was 430. Was it your wages and salaries are there? Is it as 580? So both of those there, I would have thought, would be pretty straightforward. Okay. Then the challenge, isn't there? Okay, your cash received from your credit customers. So what we're going to go through and do there is we're going to go through and draw up a T account. It's like, oh no, Chris, don't do T accounts. We don't like them. You should love them. Okay, we're going to draw up a receivables T account. I know you're training to be a management accountant, but T accounts are still vitally important. So receivables, you put in there, is it your brought forward, your opening receivable? That there is 400. Your closing receivable is there, is it as 500? And you have there your sales for the year, assuming that they are all on credit. Debit receivables, credit sales, don't we? Okay. What you've got there, when you go through and balance it all up, is it 100 on the left? Is it there 100 on the right? That gives me a balancing figure, is it of 600? That there, isn't it, is your cash that you have received from your credit customers, isn't it? As you've debited bank, credited the receivable. So the receivable, the movement has given us an inflow, is it of 600? Okay, excellent. If you then want, is it the payable figure? So the payable is a liability, isn't it? So we put on, is it the credit side, the opening liability? So the opening liability, I think, was 300. The closing liability that you have is 450. Your purchases, you debit purchases, credit payables. Gives you 3,600. And that gives me a balancing figure, is it of 3,150. Again, that entry is a cash entry as you've credited payables, credited bank, careful, credited bank and debited your payables. Okay, yeah, excellent. So you've got there, is it 3,150 as an outflow? And once you've got that, you can then work out, is it your cash from your operating activities? Is there as 440. Okay, excellent. I can hear some of you there crying at the other end of the internet connection because we've used T accounts. If you don't like your T accounts, then what you can go through and do is you could just put in your brought forward, your statement of profit or loss, and then deduct your carry forward to give you your cash figure. I shouldn't tell you these things, but if it makes it easier, there we go. Because we can go through there and think about your sales. We can think there about your purchases. So the brought forward, if you like, figure to related to your sales was your receivable at 400. The sales figure for the year was 4,700. and you can deduct the closing balance, is it there, of 500. Gives you there, is it for 600. And similarly with the purchases related to your payables, you take your opening, you add on the statement of profit or loss figure, you deduct the closing figure, which was 450. Was that 3150, if memory serves me right? Yeah, it gives me there, is it 3150. Okay, so you've got exactly the same figures as what we had with the T account using this shorthand method. Take your opening, add on the expense or income, and then deduct the carry forward figure. Okay, up to you. Use that method there if it makes it easier. Bear in mind, as you move through the syllabus and move through the qualifications, a fundamental understanding of debits, credits, and T accounts does make things easier. Okay, but there you've got right at the very bottom the overall figure from your direct method is there, is it as 440. Excellent. Following on from the direct method that we've gone through and looked at, we're now going to look at the indirect method. So remember, the indirect method is whereby we use the financial statements as they are presented to be able to go through there and work out the cash from your operating activities. Okay, so there's a pro forma essentially that you need to go through there and commit to memory and learn, because what we're going to do is we're going to convert a profit figure back to a cash figure. So what do we do? Well, the first thing we do is we start off with your profit before tax. I always find that a little bit strange, starting with PBT, because remember, you're trying to work out a cash from the operating profit. So why don't you start with your operating profit, your profits before interest and tax? We don't. Okay, we start off with PBT. So what we need to do is we need to get back to, don't we, that profit before interest and tax. So if that's the case, we need to adjust for any interest expense or any interest income, don't we? So that's one of the first things that I would think about. Okay, we need to get from PBT back to PBIT, your operating profit. So adjust for interest. Now, what we've done is going down from operating profit to PBT, we have added in any investment income, haven't we? So if we're going back the other way, we need to deduct that investment income, don't we? If you're thinking about your finance cost is an expense, isn't it? That finance cost expense will have been deducted to bring us down to PBT. But if we're going back up to get to your operating profit or your profits before your interest and tax, but if that interest expense was deducted, we need to add it back on, don't we? Okay, so I think it's vitally important that you understand how we deal with that interest income and the finance cost. Essentially, what you're doing is the opposite of what you see within the financial statement, isn't it? Interest expense has been deducted, add it back. Interest income has been added in, deduct it. Okay, we'll deal with it on a cash basis later on. Okay, other thing that you've then got to deal with as well are any non-cash items. So the prime example that you have there usually is looking at depreciation. There could be other non-cash items such as amortization, profit or losses on disposal of PPE. But for now, we're just going to worry about depreciation. It's a non-cash entry, isn't it? It reduces the value of the asset. So you credit accumulated depreciation and you debit depreciation expense. Doesn't reduce cash, does it? Okay, so it's a non-cash expense. So therefore, you need to add that back to remove the expense from our cash figure. Okay, so non-cash expenses, you add them back on. Okay, you then have the challenging bit, which hopefully you can remember, can't you, from the days of your certificate exam. You need to adjust, isn't it, for all the working capital balances, any accruals or any prepayment balances that there may be within your current assets and current liabilities. So here we're just going to focus on inventory, receivables and payables. I'm not worried about accruals, prepayments or any other balances that there may be. So if you've got there an increase in inventory, an increase in your receivables, you have, if you like, the increased inventory leads to an outflow of cash, doesn't it? Because in order to have increased the inventory, you need to have bought the inventory, and to buy the inventory requires extra cash, doesn't it? Okay. Likewise, if you've got an increase in receivables, it means that your sales have gone up on credit, doesn't it? Because you've debited receivables, credited sales. So as the receivables have gone up, your sales have gone up. If your sales have gone up, your profit's gone up. But if you've not collected the cash, then you need to remove that increase in receivables to get back to a cash figure, don't we? Okay. If you have an increase in your payables, then that means that your liability has gone up. If your liability has gone up, you have not spent the cash, have you, on paying off your supplier. So therefore, you are going to increase the figure within your indirect method, isn't it? Essentially, yeah, you've bought goods on credit. Yeah, the liability's gone up. Where's the cash? It's in your back pocket. Okay, so therefore, we need to add that back in to the computation. Totaling everything up, that should then go through there and give you, is it your cash from your operating activities? Okay. And let's demonstrate it, shall we, with the example. Okay, we'll work it through together. If you so wish, feel free to go through there and attempt it by yourselves. And then come back and have a look at the video to see what we've done. Okay. So the question at the bottom there says, calculate the cash from your operating activity to appear in the company statement of cash flow. It doesn't specifically say to use the indirect method, but we have, don't we, extract from the financial statement. So we will use the financial statement, which means in using the indirect method, doesn't it? Okay. So again, you can write out the pro forma if you so wish. But remember, the key bit there is that you start, don't you, with your profit before tax, PBT. Is that there at 2850? Okay. So what we've got there is that we start off with profit before tax. Is that 2850, isn't it? Okay. Once you've got the 2850, I would then look up, because we want to get back, don't we, to your operating profit. Profit before interest and tax. Well, what they've done there is they've added on the investment income to get to PBT. So what we need to go through and do there is we need to remove that investment income to get back to your operating profit. Similarly, we need to adjust, don't we, for your finance cost. The finance cost figure there has been deducted, hasn't it, to get back, or to get to profit before tax. So to get back to the top up there, yeah, your profit before interest and tax, we're going to have to add on that 500. Okay, if you work it through, 2850 less 150 plus 500 gives me 3,200, doesn't it? Which is the same PBIT figure that we have there. We could just start from the 3,200, but we don't. Okay, we start at PBT and then work backwards to your operating profit. It's crazy, isn't it? But that's what the standard says to go through and do. Okay. Then we need to go through there and look at the non-cash items. So you've got there as your depreciation, which is there as 850. So depreciation, we will add that back on as a non-cash expense. So that's nice and straightforward, particularly if it's given to you. We then need to look, don't we, at the movement in your inventory, receivables and payables. So what you've got there, make sure that you're going the right way. X4 is the opening, X5 is the closing. So you can see there is there a reduction in inventory. There is an increase in receivables. And there is a reduction in your payables. Okay. So there's a reduction in inventory. So let's write that down. Reduction in inventory. The inventory is now, is it 6,500? It was 7,200. So there is a reduction, is it, of 700. If your inventory has reduced, it's because you've sold more. And if you've sold more, you generate more cash, don't we? Okay, so that reduction in inventory gives you more cash. There was then, wasn't there, an increase in your receivables. What was the increase? Well, 4,300 now from 3,900. The difference is 400. An increase in receivables is because you have not collected in the cash. If you've not collected in the cash, you have less cash, haven't we? So therefore, that reduction of 400 due to the increase in the receivables. The payables have gone down. So we have a reduction in your payables. The payables are now at, is it 5,200? They were at 6,500. So the absolute movement is 1,300. Be careful if there is a reduction in payables. That's because you have paid off your supplier, isn't it? So that reduction in payables gives you a reduction in cash. Once you've done that, it's all complete. We can then just figure it all out. 2,850 less the 150 plus 500 plus 850 plus 700 less 400 less 1,300 gives me there, is it 3,050. Okay, that's your cash from your operations. Okay, there we go. Excellent. Work it through with a couple of examples. It's revision essentially, isn't it, from the certificate level? So hopefully you shouldn't find that too challenging. Okay. Having gone through and calculated our cash from our operations using either direct or the indirect method, you probably have a particular favourite, or maybe you don't like either of them. What we then need to go through and do is we need to deduct, is it your interest paid and tax paid, to get your cash generated from the operating activities. Okay, so we've worked out the cash from operations using the direct and indirect method. Now we're going to go through there and work out the cash from your operating activities. Okay, so do just be careful. There is a difference, isn't there? Cash from your operating activities is after the deduction of interest and tax. Okay, your cash generated from operations is using the indirect and direct method. So do just be careful on particular objective test questions. So it's up to you. Personally, I'm old-fashioned, I'm old school. I think you can see that already with my use of T accounts in the earlier example for your direct method. But we'll look at other options as well. In terms of interest paid and tax paid, both of them are liabilities, so you can both draw them up as T accounts with the opening balance on the credit side, isn't it? Okay, so remember, we drive on the left, don't we? And we crash on the right, or at least you do if you're in the UK. Okay, so you've got your opening liability. Your closing liability is then on the debit side, isn't it? Ready to bring forward on the credit side. And then what we do is we adjust the expense figure for the opening and closing figures to get you to your cash figure. So here on the interest payable, you've got your finance cost as the expense. As you debit the expense, credit your interest payable as you owe more money. And then for the tax payable, you debit your tax expense and credit your tax payable, again, as you owe more money to the authorities. Once you've done that, you can then balance it off. The balancing figure there is on the debit side, as you have credited the bank with the payment and then debited the liability, reducing the liability. Okay. What's difficult about T accounts? Nothing. Chris, they're impossible. What you could do alternatively, if you don't like T accounts, like we saw earlier, you could go through there, take your brought forward with your statement of profit or loss and your carry forward figure. You can deduct the carry forward figure. So here, the profit or loss figure will be for your tax or your interest expense. So finance cost. And you take your opening, add on the expense, and deduct the carry forward to give you your cash figure. Okay. I know, that's much easier than T accounts, but I do think that fundamental principles are important. Okay, if you understand the fundamental principles of debits and credits, you're going to make a pretty good accountant. Okay, so let's go. Let's have a look at the little example, see how we get along. There we go, perfect. Okay, fits on the screen quite nicely, doesn't it? So what have we got there? It says calculate, is it interest paid and tax paid to appear within the company statement of cash flows. Okay, so what you can see there at the bottom is you have your opening figures and is it your closing figures. So X4 is the brought forward, X5 is the carry forward, and then you have an income tax figure and you have is it a finance cost figure. Okay, so we can go through there, can't we, and then play around with those amounts. I'm going to use a T account. Okay, so what you've got there is if we go through and look at is it our interest payable, my opening interest payable figure that we have is 90 on the credit side. The carry forward is it there as 120. The finance cost that you had, was it there as 500, wasn't it? So when you balance it up, you don't even need to balance it up properly within the exam. You have 590 on the right. You have 590 on the left. Your balancing figure that you have is that, I won't even use my calculator, boy oh boy, I'm being brave there, aren't I? That's 470. Okay, and that figure there, what does that relate to? That is your interest paid. Remember, it's a paid figure, it's an outflow, so it would have to go in your brackets, wouldn't it? Okay, or you could just do 90 plus 500 less 120, opening plus expense less carry forward gives you 470. But there we go. The other figure that you've got to go through and calculate there is your tax payable, isn't it? Or using your tax payable T account to work out the tax paid. So you've got there, is it your opening tax liability was, I think, 210. Your closing tax liability is 180. Your tax expense that you have is there as 350. Add it up both sides, it's 560 right. 560 left. Is that there? Then your balancing figure is 380. And that is your tax paid figure. Okay, 380. There we go. Excellent. If either of those crop up as an objective text question, you know that luck is on your side on that day. Okay, have a word for the question, see how you get on, and that's everything to do, isn't it, with your operating activities. We've worked out the cash from operation using the direct and the indirect method, and then we've used T accounts or your shortcut method to work out interest paid and tax paid. Okay, hopefully you're comfortable with those bits that you've seen previously from your certificate level.